Hey, what's up, everyone, and welcome back for Tuesday, March 4th. S&P 500 was down 1.2% today. Dow Jones was down 1.5%, NASDAQ 0.35%, and New York Stock Exchange Composite down 1.65%. So another red day. A lot of negative news out in the market today. Obviously, we opened pretty red. It kind of came up throughout the day, and then right there before close, we experienced another little fall off there. For today's top strategies, you can see Sharpe's measure has kind of given way this week to Trainer's measure. The returns yesterday that were in the positive now look to be in the negative. Now you can see that there's only 4 strategies that were actually are positive week to date so far, with Trainer's measure in the lead. Now, to take a second just to talk about Trainer's measure, it's very similar to Sharpe's measure in that the numerator is the risk premium. And if you remember what that is, it's the estimated return minus the risk-free rate, which is typically a 1-month Treasury T-bill rate. And then instead of with the Sharpe's measure, it's over risk. But with Trainer's measure, it's over beta. And we'll talk a little bit more about beta here in just a moment. But essentially what that means, if you recall, with the Sharpe's measure, it's the reward to volatility ratio. So it's how much return that's produced for each unit of risk you're taking on. Whereas with the Trainer's measure, it's a little bit different in that you still have that risk premium on top, but then you're dividing it by beta. So it's how much return the asset is producing for each movement in the market. And we'll talk a little bit more about beta today after we go through our portfolio recap. But again, it's a measure that in terms of what this means from a strategy standpoint for Wall Street, what they're doing is they're moving from very safe assets to assets that typically perform well in a volatile market, which is what Trainer's measure is going to help you identify. And then again, you can see just relatively few stocks, mostly 5 stocks, are on the leaderboard today for either the smallest losses or the biggest gains out of those test funds. For highest volume, again, another day with NVIDIA on top. Let's take a look down here in terms of the biggest gains and losses. Looks like Mass had a major gain here. Host Therapies. China Liberal Education Holdings, if you take a look at their returns over the last week, they are all over the place. They had a share consolidation yesterday, which has probably led to some of those returns today. Akoda is a technology company that's been mentioned a lot today and yesterday in the news. And then you can see some of the largest losses. I believe BioXcel yesterday was actually one of the largest gainers. So it's interesting to see it pop on here as one of the largest. And again, just as a reminder, with the biggest gains and biggest losses, this is not, me advocating for any of these stocks. These are just stocks that experience a large, or are experiencing, a large either gain or loss. And typically, a lot of times, if you monitor them, you'll see kind of the inverse of that within the next few days, where things tend to balance out. But ultimately, volatility is probably not something that you really want to stomach when it comes to your portfolio, and beta is something that can really help you with that. So we'll get to that right after we take a look at our portfolio. So our portfolio for today, the S&P 500 was down 1.22%. The portfolio was down 0.54%. So that's a good thing when you have a properly optimized portfolio. A lot of times what you're going to see, sometimes you don't always see the major gains. If the market goes up 2% in the day, maybe you only get a point and a half. But the inverse of that is when the market is losing money, sometimes it works to your advantage where you lose less. And that's exactly what you're seeing this week. Yesterday, of return on the S&P 500 of negative 1.76%. Today, negative 1.22%, whereas the portfolio was negative 1.33 and negative 0.54. So what that's done to our trend is it's brought it back closer together. And you can see overall, since we made the investment, the S&P 500 has actually lost 3.94%, whereas the portfolio has lost 3.87%. So we've actually, in terms of that comparison, have beaten the market since we entered into this investment as of today. But, we're still at a loss. So, of course, we don't want to see that, but you kind of, try to find the positives where you can. And then Outside of that, one of the major losses for this portfolio, if you're not familiar, is Tesla at the moment. They've experienced some major losses the last few days, and then today they announced that they saw about a 49% reduction in purchases in China, in the Chinese market. So that softening of demand means fewer EVs going out to market for them, which of course equates to lower net present value of their corporation, and thus the loss in their share price. All right, so I think that's about it for today. What I want to do is I want to show a brief clip. What I want to do is show a brief clip that is actually out of one of my training lessons. It's one of the first lessons, and it covers beta and some of the basics that you need to understand and know when leveraging beta. And beta is something that we integrate in our platform here. Like if I go over to the search function and you pull up and you can see the assets here, you'll notice that beta is one of the metrics that we provide you on our site as well. You can provide it, or you can find it on all of the main sites that are out there. So let's take a closer look and learn a little bit more about beta. Okay, beta. A few moments ago, I mentioned that you may be interested in why expected return or trainer's measure might lead you down a path with a strategy that's a little bit more difficult to stomach. Essentially, what you need to understand is that for a lot of the assets that have high expected returns and trainer's measures, they're going to move a lot with the market, and beta is the measurement that will help you understand by how much. So if we look at this chart on the left here, this black line would represent an index like the S&P 500. So this is how that particular index would be moving over the course of that week. What you can see here is if you have a beta of 1, you have the orange line. Well, you can't even see the orange line because it's hidden behind the black line, which is the concept of a beta of 1, meaning that the stock is essentially just moving proportional to the index. Now, it's true that it won't look like this chart. Not every move every day will be aligned, but over time, the movements are going to be proportional to the index. So if you're looking at a stock with a beta of 2, for every gain or loss in the market, the gain or loss for that stock is essentially multiplied by a factor of 2. So what you're seeing with some of these assets that the computer selected, for example, were assets with betas of 4 or 5, and in some cases even higher. So you can just imagine if the market loses 2% in a day and you've got a beta of 5, well, you just lost 10%. Now, you could have gained 10% as well, but that's what I'm getting into about the volatility that beta can help you identify. So you really need to know how that works, because if you select a whole bunch of assets that have betas of 2, 3, 4, or 5, or even higher, then what you're going to have is a very highly volatile portfolio where you could gain or lose 10, 20, or even 30% in a day. And I don't know about you, but most people can't handle that kind of stress. So what you're looking for in your goal with beta should be to find assets that are close to or near 1, and that will provide you with a portfolio that moves a lot more like an index fund. All right, that's it for today's recap. I hope you all have a great night. I'll see you tomorrow.